Today's guest is Yat Siu, the co-founder and executive chairman of Animoca Brands. Animoca operates across a number of pillars, from operating Web3 businesses to advising regulated stablecoin projects to having an investment portfolio of over 540 companies, which is one of the largest in the crypto space. While Yat isn't necessarily American-focused, he has a strong understanding of the U.S. markets, founders operating in the space, and a vision into it all, so we're excited to have him on today. Yat, welcome to the show.
Thank you for having me again. And just a quick correction, we are now at 573 portfolio companies. So we continue to invest.
Oh my gosh. 573.
573.
So there we go. I missed 30, which is very impressive. But to start off, can you tell us, what does crypto in America mean to you?
Well, if I had to put it in a nutshell, it's probably the biggest and fastest growth opportunity in crypto today, right? And if you think about what happened in the last 4 years, 5 years in America, it's really sort of this pent-up demand, of course, accelerated very much by your current administration, but also the whole underswell, this sort of people who are like dying to come out and say, hey, actually, we love this, but we're not allowed to do it. This is for people in the so-called traditional sectors, or in gaming, or in all sorts of other industries. They're all able to come out. It's almost like people talk about sort of Trump Liberation Day in other contexts, but certainly in the crypto industry, it definitely feels like Liberation Day and Freedom Day, and I don't know, whatever you want to call it. So there's outside of that feeling, there's everyone around the world thinking about what can we do and how should we build in America and how should we invest in America. And I think there's a unique sort of opportunity for companies like us because of the past administrations and the very hostile and aggressive actions of the prior administration. America has fallen behind for the time being, right? And you can see this. And this is, for instance, when you look at our business, we don't have at the moment a peer in America, which is kind of interesting, right? There's no other technology field where America isn't at least on par, if not actually clearly leading or sometimes completely dominating, whether it's social media, AI, chip production, whatever you call it, right? The biggest companies in tech or in innovation broadly are sort of America-based, except for, crypto and blockchain, which is really a shame. Now, America's going to catch up really, really fast. And so that means that all this talent that's there that wants to build and do stuff, as an investor, you want to invest there, right? Because it's probably, where the most energy is. But at the same time, if you're a business, that's an opportunity to build there as well, because in a way, you could actually, for the first time, perhaps to gain market share in areas that maybe wasn't possible before. You can even see this with exchanges. In a way, the whole sort of hostile regime previously inadvertently gave Coinbase regulatory capture. Not because they loved them, quite the opposite, but because of the fact that nobody else could be a viable alternative in America. And so Coinbase became the only alternative. And now, on one hand, they've succeeded in sort of creating a much better framework for America, but it also opened the market for everyone else to come in, and all the major exchanges around the world, which by sort of quantum of size in terms of volume, like the Binances or OKXs of the world, are all looking to enter the US as well, right? So that's an interesting dynamic around that. And it's even with stablecoins, right? I mean, because the Genius Act will very likely pass, and that means you're going to have every bank sort of probably do a stablecoin of some sort. What does it mean for Circle and for Tether, who in a way also had a kind of regulatory capture because nobody else could really do it without getting in trouble? And hey, now it's kind of open season for everyone. So it's definitely an interesting dynamic, but it's an opportunity. And I think anyone in doing anything in crypto would be making a mistake to not look at the US very seriously.
Mm-hmm. So would you say your opinion of the US market has changed, or maybe there's more opportunity now? How would you kind of define the state of Web3 innovation in the US, given everything that has changed in the recent months?
So I think it's a bit early to talk about the specific innovations in terms of new tech, for instance, because a lot of it is sort of building and hasn't really emerged. A lot of the American entrepreneurs have sort of gone overseas, for instance, to build their stuff. That doesn't mean that they're less American. It just means that the product innovation is done in a foundation in Cayman or like someplace like that, right? And they left the country, so they're all coming back. So I think that's one thing. Right now, I would say the biggest area of so-called innovation is really sort of the financial sort of productization of the stock market, right? So whether this is sort of, a Bitcoin hodling company or a Bitcoin acquiring strategy or Bitcoin mining business right now, that's kind of the meta, although that is out shifting, now it's moved into Ethereum, right? Joe Lubin's getting into the game as well, right? So it's sort of taking advantage of what America has always been really good at, which is the financial markets. At the end of the day, the TradFi markets are the biggest, right? If you think also, when you look at sort of ETFs, when ETFs finally were approved for Bitcoin, America's sort of financial TradFi industry literally steamrolled over everyone, right? There's not even a close second, right? America just completely dominated it. And I would say something similar is now happening with the capital markets as well, not just in the form of MicroStrategy, but every alternative version of that. So I think that's kind of where we're seeing a lot of the, let's call it, current form of innovation in terms of attention and market dynamics, which of course means that it's going to suck capital into the nation, which is what it's doing, which means that new developments will happen. So it's a little bit almost like meme coins, or well, not quite, which is like, okay, well, we have one strategy, which is to acquire Bitcoin. Later on, we need to have something else that comes from that, right? Oh, we need to innovate. Okay, well, we've got all this money. How do we innovate? Let's invest in this company. Let's build something there, right? As they try to sort of differentiate themselves. So the key is there's capital, and from capital you can build and invest, and I think that's kind of where we are right now. Of course, there's great research and great development going on, but it hasn't come out fully yet because we're only really talking about sort of half a year, really, when you think about it.
Yeah, you mentioned the treasury companies. I want to get your take on that. Is that a fad, or is that something we're going to continue to see, these companies putting Bitcoin or whether it's another digital asset on their balance sheets? What's your take?
I mean, there's certainly something fatty about it, and that's just because it's the meta, and therefore, let's go. It's a pretty safe way to do it as well, which is that if you believe, as most of us do, that Bitcoin is going to continue to go up in value at some point in time, then sort of buying that from a treasury standpoint makes sense. It's kind of like diversifying. It's not that different from companies in the very early days buying real estate or companies buying gold, right? It's just that once the attention is no longer there, like for instance, the next 10 companies putting Bitcoin on their balance sheet is going to have less attention. And the next 10 and 20 are going to have even less attention. And then the only way to compete, as it so happens in those markets, is that, well, I'm buying more Bitcoin than you, right? So it's like, okay, now it's not enough to just have a percentage of Bitcoin. Now it's like, I'm buying $400 million of Bitcoin. Okay, that's a lot. No, I'm buying $1 billion. No, I'm buying $2 billion, right? And then the next thing you know, it just doesn't become feasible for companies to compete at that level. And we go back to MicroStrategy and those ones who are already doing it in size, right? Now that's net positive for the industry. But if you're a sort of, let's call it, typically small sort of listed company seeking attention, it will no longer be enough to say I bought Bitcoin. So I think that's kind of a good strategy from an accumulation standpoint, but it will no longer give you that attention. So the premium of doing it won't be worth it, right? So you won't get investors say, oh, I want to buy Bitcoin, I can do it through this company in a better value proposition, and you won't get like say the 300-400%. And then you may get 200%. And by the way, in tokens, we didn't see this too, right? The first gaming token that comes out is like, wildly knocks it out of the park. And then the next one does a little bit less. And the next one does a little bit less, right? And next thing you know, everyone does it. And yeah, there's growth, but it's more fundamental. You look at more fundamental and utility. So we think what's going to happen is that this will translate first into the next layer of tokens. So you see it with Ethereum, you see it with Solana. I expect all the other ones to do it as well, whether it's a Sui or an Aptos or a Ton and so forth, right? So everything in a portfolio will eventually find a way to do that. And you see diversified versions of this. And then the next level is going to be, okay, what's the utility? What are the products around that, right? So I think there is a little bit of a hype phase, but I think it's good because it just draws attention to the industry. So I think it's a net positive.
Yeah. So I want to dig further into something you mentioned at the start of the show, which is a sort of overall sort of corporate strategy that you guys have pursued and seems to be a much more successful model in Asia versus the United States. So in full disclosure, so I used to advise a company called Darewise that was in the portfolio. We worked with you guys together on the Opal Foundation as well. So familiar with kind of the Animoca universe, as it were. You mentioned the sort of top to bottom sort of conglomerate structure almost that you guys have deployed at Animoca, and we've seen sort of the super app and like WeChat. In Asia, there's been a lot of, I guess you could call it consolidation across that business model. Do you think, so you alluded to kind of Coinbase sort of ending up in that spot, kind of, by way of, you called it regulatory capture. Do you see with the shifting environment in the States more kind of super apps? Do you think the regulatory environment will enable that? Or do you think that it's still going to be kind of bits and pieces, this sort of consortium model here?
Yeah, so generally speaking, because of the nature, particularly the permissionless nature of blockchain and Web3, I don't see the same structure as we see like a super app. Like a super app is a way in which you can, like for instance, in a way you could say Telegram, with Ton is trying to do a version of that, and I think it will succeed in its own way. But because of the permissionless nature of blockchain, you don't have a way in which you can construct a monopoly network and have complete dominion over the network effects, right? So for instance, if Bitcoin or Ethereum or Solana does really, really well, which of course we all hope it does, actually it's good for the entire ecosystem. It flows through because I can move my liquidity down, whether I take profit and buy another token, whether I use it as collateral and draw liquidity elsewhere. That's not possible in Web 2, right? If Facebook, becomes twice the size, this is bad news for everyone else, right? This is not good news, right? Microsoft and Apple and all those guys would be terrified at that. And so I think so the Asia model, one of the reasons why Asia seems to and currently has more progress in America has more to do with what the enforcement structure in America looked like before, right? You were essentially sort of I guess the SEC was playing whack-a-mole with people in crypto, and so as a result, nobody was able to really develop something, and there was also fear, right? So we invested in probably 50 or 60 American-led or American businesses in the crypto space, maybe more. I mean, I'm not counting the specifics, but some of the big ones, whether it's an OpenSea, right, as an example, or the guys at Igloo, Pudgy Penguins, or the Bored Ape guys with Yuga Labs, right? These are all part of our portfolio. In many cases, we were sort of first money in to those guys. And, the way that they had to operate before, which is like, well, we had to set up this foundation. We're not really involved in this. We have to separate ourselves, right? It creates, it's like sort of, battling in the global scene with your hands tied behind your back. It's kind of tough, right? So I think, in many ways, they were sort of working from a disadvantage that no longer exists. So that's kind of one thing. But the second one, and this speaks more about how we think about the space, is that this industry, is about network effects. And one of the most powerful things about network effects is what in classic TradFi you call goodwill, but it's really brand and brand power, right? And to us, that explains things like why meme coins, despite the fact that they have zero utility and existed for a certain reason, have value because they have a network effect that binds community around goodwill effectively, right? And that goodwill can be worth billions of dollars, or sometimes it can be worth very little. But the point is that there's a network effect that comes from that. And so when we think about investing in the space, it's not so much about, because many of them, of the 573, these are all minority investments. So we don't count the companies that are consolidated like Sandbox. They're not part of the 573, right? Those would be subsidiaries, right? Of which we have like a dozen or so, right? That's a different category. And that's because we think that that's actually how you sort of build goodwill in the industry, because it creates growth, because it creates, more users going into the space. And it's also our promise to the ecosystem that, when we make money, we reinvest. And I give sort of this example, and this is why we like what's going on in Web3. So I like in Web3 as to, so what's the secret of Silicon Valley? A lot of people around the world are like, but what Silicon Valley, tech hub, why does it do so well? What's the magic sauce? And then they go and land in Palo Alto and they go like, this is kind of unimpressive, right? It's a bunch of low rises, right? Actually, my cell
bunch
phone,
of billboards,
restaurants are okay. I mean, some nice places, but probably it's not New York, right? It's not Hong Kong, it's not Tokyo, right? It's pretty sort of, wisteria lane, like in a way, it's like there's not much going on. And the infrastructure is bad too. Like my phone barely works sometimes, the internet is not what it is. So this is a home of technology. Like seriously, what's going on here? And it's because everyone there invests in each other. Like angel investing and seed investing is literally a sport. right? It's in a local Starbucks. People talk about the deals they've done, the founder they met. My son had a startup there, back, like 4 years ago. And he got in front of some of the biggest guys, and he was like 17 or 18, right? And, they got a little bit of funding. And but the point is that it's normal. It's okay. Like it's part of that industry. You could be an engineer at Google, you're an angel investor, right? It's not like you made it and then you're part of a big fund, right? This would not happen in places like Hong Kong, or maybe in many parts of America, a little bit more in New York, but not the same way that is in Silicon Valley. It's this reinvesting culture that has created this incredible ecosystem that is unparalleled, right? And in Web3, that's what we do the whole time. So every person who's made money in Web3, they redeploy back into the ecosystem, right? They take some profit, but they also back this founder. In fact, they back founders they don't even know, right? They get rug pulled because they just trust that, hey, this looks like an opportunity. But the point is that there's an appetite to risk, and there's a sport as well in terms of, hey, let's invest in this, let's do something here. That's cool, and that's what they do, and that's what they talk about, right? So I think that's the model outside of the reason why this growth is so captivating. It's the model of the most successful Web3 companies have to reinvest back into it. So if you do business with us and when we make money, then you know that we'll keep putting money into the ecosystem as well, because new users will come in. There's new product categories, whether this is gaming or education, doesn't really matter the category, because once those users enter Web3, it's not only in our ecosystem, they can come use your product because it's permissionless, right? And you notice this, like Coinbase Ventures is one of the largest investment portfolios as well. OKX has it too. Binance has it too. Like the New York Stock Exchange doesn't have an investment portfolio, right? Or Apple doesn't have an investment portfolio. I mean, that's the crazy thing. When Epic sort of won this battle around the whole sort of payment stuff and the sort of the Fortnite battle with Apple, despite the size of the ecosystem and Apple being the most valuable and arguably most powerful company in the world, did anyone come to defend Apple for their 30%? Nobody. No. Absolute crickets, right?
Maybe Apple did.
Yeah, exactly. Maybe some people inside Apple. But even some people inside Apple, I mean, it wasn't like Apple staffers went out and said,
right,
protect Apple, maintain the 30%, right? It was, and that's because actually there was no moral grounding to do so. Nobody felt good about it because it was purely extractive. Now, if Apple had an ecosystem fund and they were deploying like a single-digit percentage of their cash, which is tiny, it's like a rounding error. It's like the interest that they make on probably a monthly basis, right? And actually deployed that as an ecosystem fund for App Store developers and said, look, we charge you 30%, but we're funding this ecosystem that grows it and develops it. It's no different than people around the world saying, well, pay your taxes because it's good for us, right? There's some people who don't want to pay taxes, but most people would object to the fact that there would be reduction of taxes because they know it pays for social services or invests in infrastructure or builds a school, right? So it's the same thing. And I think tech companies don't think like ecosystems when they have to, when they should be. But in Web3, we all think in forms of ecosystems. So the business modus operandi has to incorporate ecosystem mindset. And so that's why, I think we're not the only ones. And I think we're maybe an example of other companies. If you want to be in Web3, or if you want to enter the space, then you must be an active investor as well.
Mm-hmm. One way or another.
That's
I want
right.
to pull back to what you were saying before about Silicon Valley, because I was a reporter for a long time at TechCrunch, and that was something that we heard from either VCs we interviewed or, maybe internally they were just like, there's such a focus on San Francisco. We would have our annual conference out there. I was based in New York, still am, and they always kind of wanted to hire in SF. And I was like, listen, there's a ton of activity going on in New York and in a global market, but that is from a Web3 perspective, right?
Correct.
And then you talk about the angel investing and all these different areas. And I do agree with you that with San Francisco, yes, there's activity out there. Yes, people like your son or any founder can go out there and probably, if they have a good idea, get some checks. Mm-hmm. And it's like an easy culture, hustle culture. Everyone out there is talking about their startups. Whereas in New York, it's like very finance driven probably. And then there's a lot of crypto activity here as well. But I think one of the questions I want to ask you on this front is when it comes to American innovation, do you see a shift from San Francisco into other hubs? And then how are you still looking at investing in American founders, whether they are stateside or still international?
So we don't necessarily discriminate where you're based on, although we are focusing obviously on a lot of American businesses just because we think as a market it makes sense. So if your market is the American market, obviously it's good if you're in the US, right? Right?
Right.
It's no different than if you're doing something in Japan or in Middle East or in Saudis and so forth. But generally we look for great founders. And I think there's something about the sort of, chaotic and sort of, I would say America is probably the best place and the most incredible place when it comes to creative destruction. I don't think there's really anything quite like it, right? Where you can go through these incredible waves of mass creative destruction, but then creative reconstruction, shall we say, that is unique to America, which is very unbalancing to most nations around the world, except in America, where the sort of disruption actually causes and creates new industries. And so I think that's very much a sort of, flavor Americana. And that's something that I don't think is replicable anywhere else in the world, right? It's because of your culture. It's
I was going to say, how would you define creative disruption in the US though? Whereas like other markets?
Well, it's, whether this is in your politics or whether it's in your business, you have no problem in literally blowing it all up, right? And starting all over
style.
Again, right?
Yeah.
And it comes somewhat also to the transactional nature of how you do business as well. It also comes to the speed of things. But there's an interesting resilience around that because America has a great sort of, I guess, philosophy around individuality, which is different amongst other parts of the world. And this is good and bad. You can see this over COVID, right? Like everyone in Asia is wearing masks and they're like, okay, it's better for society. We can agree on the structure. But it also means that there's less willingness to disrupt the harmony of a certain society. And when there is that disruption, there is more antibodies in that culture against it. For instance, Europe is a great example, right? Where it's really hard to innovate, not just because of the governments, but also the people themselves, right? And I think this comes down to the point about why is innovation moving somewhat away. First of all, I don't think Silicon Valley will ever truly lose it because there's a culture there for technology. But the one thing about blockchain and Web3 and crypto is that it really democratizes and financifies everything in that field. So in the same way that, frankly, we will no longer be talking about AI because everything will be AI. It's kind of like back in the day, we didn't talk about, there was an internet company, right? Well, we don't talk about internet companies anymore because you're either on the internet or you're not. If you're on the internet, you're not on the internet, you're probably irrelevant, right? And the same with AI. And what Web3 is doing is it's doing the same for fintech. Because everything that crypto touches, it essentially turns it into a capital asset, which means it becomes financified in one form or the other, which means that it sort of democratizes and amateurizes effectively fintech, which is really the domain for the very special who were working in Wall Street or who understood trading and who were in Hong Kong or Singapore or New York or London, right? So that's all changing. But it does explain then why the centers of crypto tend to be financially oriented places, because you need to understand money, capitalism, and essentially financial systems, not just fintech. And that to me is somewhat away from the Valley, right? And I think, Jacqueline, having been sort of working with companies there, money is an afterthought there. It's like, oh, we'll build great products, we'll change the world, and money will come. Right.
Right.
Revenue, no revenue.
Yeah. Well, who cares about that, right? Because we
got investors.
Yeah, we got investors. We're going to save the world, and the money will come. And that's one way to look at things, right? But then when you go to New York, right, it's very much about sort of about the money and the role of money and how that has an impact. And then from there, the innovation happens. And with crypto, because capital formation is so instant, you have to understand that to compete with that. And I think, Hong Kong, for instance, which is, in our part of the world, a center of digital assets and Web3, it's because of the fact that it's a financial center in the region. It is not because it has the best engineers, right? I mean, you've got some good engineers in China and stuff, but really that innovation would normally sort of not happen in a place like Hong Kong, but it happens in Hong Kong because there's a lot of insight in terms of the financial know-how and how money works. And frankly, the more capitalist the place is, right, the more successful it tends to be in crypto. So Dubai is a great example, right? Full embrace of capitalism and open markets, and boom, right? It's like a sort of, dreamland for people in crypto. which is not the construction of broadly California, I would say, in terms of their philosophy and mindset. Certainly when you look at political party lines, and certainly in the Bay Area, it's not the emphasis. And that's why I think, like, for instance, they would separate AI and crypto, when in fact AI and crypto should or could be very, very intertwined, because they're separating it with money. They don't want to connect it. It's just, and I think this is one of the reasons why Europe is also behind, because Europe has a very, very fraught relationship with money culturally, and that makes it hard for them to innovate because it's an industry that relies on the relationship with money.
I don't know if you all have noticed this recently, but Avalanche has been on a roll. From FIFA launching their own Layer 1 on Avalanche, to VanEck unveiling the purpose-built fund to back ecosystem projects, the world is watching and building on Avalanche. Web3 gaming? Avalanche-based titles like MapleStory and Off the Grid have it covered. Finance? Avalanche has got that down pat too. Entertainment? Built for that as well. On top of that, starting in 2026, Sports Illustrated Stadium will be the first major sports venue to fully adopt blockchain ticketing powered by Avalanche. Backed by a strong network of builders and dedicated community, the momentum is accelerating on Avalanche for games, music, sports, finance, and more. Want to see how Avalanche is driving adoption? Go to avax.network and check it out.
Yeah, I want to ask you a bit more about that financialization and returns. You mentioned kind of reinvesting in the ecosystem, and there are like tax considerations here, of course, also in terms of like capital gains, things like that. It makes a lot of sense for, so say as a layer one has very active ecosystem funds, puts capital back into that. And then the return profile is more, I guess, kind of organic and builder network effects focused and purely kind of financial. When you guys are thinking about the returns and the ecosystems that you're building, I coming from traditional finance, kind of fintech and healthcare VC, when I got into crypto, this idea of IRR kind of like went out the window as like a useful metric, right? Because there's basically the launch, and then in the traditional world, you have like 3 or 5 years, and maybe you go public, maybe there's M&A. Those are the opportunities for exit liquidity. In crypto, many of the projects, unfortunately or fortunately, if you don't launch a token in maybe 18 months, are deemed maybe not successful or have some kind of longer term horizon, or maybe they are looking for something different, right? They're a platform. There's plenty of great businesses that don't have tokens, but crypto investor math is kind of unique in that way. How do you guys think about the way you evaluate success with your founders? I mean, do you just want to see them very much in a Silicon Valley way? This didn't work out, go found another company. Do you want to see that liquidity, or how do you think about that?
So maybe it's helpful to think about how we think about tokens broadly, and then that kind of helps us think about sort of the space, because we think of essentially tokens and tokenization as basically expanding or in some cases creating network effects, and network effects or ownership of these network effects as an asset class that didn't exist before. So even if you look at something like a stablecoin, the fact that you tokenize the dollar actually enhances its influence and power, not just because they're buying T-bills, that's one way to look at it, right? But also because the network is larger. So more people use it, and more people are using the dollar, and the network effect of the dollar is amplified, right? And so the same is true for maybe something as meaningless as a meme coin, because you have 1 million people who own it. At minimum, you have 1 million addressable users of some product of some sort, and there's some kind of attention value that exists because of it, right? And this is the thing about sort of crypto, because of tokenization, it turns everything into a capital asset. We haven't been able, until tokenization, to be able to create a quantified way to determine the value of a network. Like, what's the value of a network effect? What's the value? Why is Ethereum worth hundreds of billions of dollars, for instance? When the actual cost of, like, if you measure it based on how much gas it burns, that's not enough, right? But it's because there's a network and there's a community and all that stuff that adds it. So that to me is sort of this new asset class. But it's, again, no different than sort of goodwill and brand value and intellectual property rights, right? In fact, IP, trademarks, trade secrets, that as a industry, I think WIPO estimates that to be almost a $68 trillion market, right? And that is entirely virtual as well. That doesn't exist physically, but it is a goodwill business, right? And now we have the ability to capitalize smaller things of goodwill, whether it's a meme or cultural idea that didn't exist before, right? So that means that tokenization isn't, like you can build a very successful business without tokenizing, but tokenizing is about expanding your network. So you'll see more founders do that, where they're not looking, for instance, to raise any money from the token itself, right? That was one mechanism. It's not to say it's not possible, but it's to say that many of them just launch a token simply giving it to the community, never raising any money. Why do you do that? It seems silly, right? Well, no, you're actually building a customer base. And, and the inspiration really was some of the very first NFT mints, because NFTs were actually free mints, right? Or very low cost mints. Right? Everyone's talking about, oh, look at the prices drop. But they forget the detail that when they first launched, they were like literally $1 or $50 or something. And the fact that they're, a Bored Ape is still trading at, floor prices like $35,000. Sure, from the heydays, it may seem down, but from where it started, it's like 35,000% up or whatever. Like, because and the people who grew that network from the beginning, the reason it has this value is because there's a community that's holding it, and there's a network effect and a goodwill inherent to that. So founders have to innovate their way of thinking of how it expands these networks. Now in Web 2, we have a way of doing this. It's called advertising, right? And we spend annually about $1.1 to $1.2 trillion in advertising, mostly in Facebook, Google, and so on, to bring attention to ourselves, right? And now we have this IOU of a token that says, you know what, I'll give you a token. And, sure, there's a liability if you just sell it. But in reality, when I give you an airdrop, at least a percentage of them will stay as a community. And maybe most will sell and some will stay, but now I have something. And my cost was essentially more like a credit, as opposed to where I'm putting out the cash to a third party who, by the way, doesn't put any of it back into the ecosystem. Like in the gaming industry, we spend $100 billion a year on advertising to bring users in. And that money that goes to Apple and Google and Facebook and all those lovely guys don't put any of it back in their industry, notwithstanding the 30% fees they charge on top, right? So I think that's how, and it keeps evolving. Right, so to answer your question, really, the founders, as they launch a token, it's like, why do you launch it, right? And sure, there are fundraising models attached to it, but in general, it's about it's part of the product. The token is a product itself, right? And it expands the power of that network. And if you do it successfully, you can build a community. And I know some people like to talk and compare, like, oh, they look at Axie and they say, or Sandbox, and they say, oh, look, this thing was worth $20 billion. Really? I mean, it
was maybe at a point.
Yeah, there was a point, right, for the attention. But these are still billion-dollar ecosystems that really wouldn't have existed if it wasn't for these network effects forming. And maybe they weren't maybe the $20 billion was a flash in a pan. They were worth maybe for a month or two, but really you look at it over time. And so I would say these models are much more successful. So, solving good airdrops to me is, for instance, an example that is very critical, which is what we're trying to solve with digital identity and Mochaverse and reputation. Because if you keep dropping to bots, that's like no different than, I don't know if you remember back in the days of advertising, click farming, right? So which is why sort of the advertising industry went from CPC, which was the industry standard for a while, to basically CPI and CPA, because they had to sort of measure the quality of the user. And that's the same that we have in Web3, which is, we give airdrops. And yeah, sure, first we only cared about getting millions of users. And then we're like, wait, hold on. But if, 99% of them are bots, that's not so good because you're not building a network. So then we have to go into that next level. We have to determine more, and it's getting harder, but there's more value given to the user, right? So it's just part of that evolution. So we're getting there, but I see the advertising industry completely flipping upside down, because now everyone essentially can offer these tokenized IOUs to build their networks, which is really, I think, much more powerful and much more engaging in community building than using a third-party advertising network that you have to keep re-advertising to reacquire your existing user.
You mentioned onboarding users through gaming, and I know Animoca Brands has a lot of gaming portcos.
About 165.
Are you still seeing a lot of interest? Yep, there you go. Are you still seeing a lot of interest in the gaming side of things?
Yes.
I think there was a theory early on for the Web3 proponents would say getting
gamers on to Web3, through these products is going to be how we get everybody on board with Web3 adoption. Are you still seeing that through the gaming side, or is it more tokenization? Is it more stablecoins?
Yeah. So, I mean, stablecoins is a category of its own. So maybe put that aside. Obviously, the biggest utility in crypto is in stablecoins, and that's also the reason why we'll get into that, I guess. But when it comes to applications on chain, gaming is actually the number one application in terms of daily active users. And so this is interesting, right? Because when you look at the tokens overall, it's about $15 billion overall market cap, maybe more, maybe 20, I don't know, right? So it's not bad. However, when you compare it to AI tokens or you compare it to other ecosystems, it feels like it's very much lagged behind, right? And so I think, again, there's a distinction between the utility, which I think gaming continues to fulfill the promise of bringing people on chain, right? Which is a big part of the mission and the vision. However, it hasn't translated into token prices. And the reason it hasn't translated token prices is because tokens are very much macro indicators, just like stock markets and sort of commodity pricing, about the state of a macro industry. And because the majority of gaming happens to be in Web 2 and not Web 3, it's influenced by that. Like, why are AI tokens hot? It's not because Web 3 AI utility is so much higher than OpenAI or Perplexity, or it has nothing to do with that. It has more to do with the fact that the whole world's talking AI and everyone's excited about the space. And so it translates into that, right? And that's actually what tokens do. Like, to me, open tokens, shall we say, the ones that are trading freely, like none of the stuff that's sort of heavily manipulated, right? Are basically like open poly markets. They give us information about the state of our attention and where it sits, right? I was temporarily cool with my kids because I was able to talk about Chill Guy, not because I knew anything about Chill Guy, I was on TikTok, but because of the fact that there was a token that sort of blew up, and I'm like, hey, what's this, right? And it's kind of like how, so now I'm dating myself, but when I was a kid and I was watching MTV, right? That was kind of how I got my attention at the time, where these news flashes came about and we're like, oh, look at this. Or, you listen to the radio and there's a song that's popular in your particular area, right? That's kind of how you gain attention. Tokens is a way in which we gain attention in terms of markets to understand what's going on. And we see this in the stock market too. Quantum computing is hot, and every quantum stock that probably will never have a usable product for the foreseeable decade or plus suddenly pumps, right? It's the same thing. It shows where that attention is. And so gaming has had a very rough 3 to 4 years post-COVID. So the macro thematic, so the utility is proven. A lot of people are going into on-chain because of gaming. However, gaming as a macro has suffered because everyone thought post-COVID we're still going to be playing games, and we are, but it hasn't grown. So the stats has been that gaming has been flat for the last 3 to 4 years, slightly declining, right? But here's a big thing. Gaming has not increased their pricing up until this coming summer for the last decade or so. Meanwhile, we know specifically in our industry what's happened with real money supply, right? Basically inflated to hell, right, with QE. So that means that gaming companies in real money terms have been making less money, which is why when you look at the headlines of gaming last 3 years, layoffs, less funding, reduction in investment, all that type of stuff is all negative. So the investor sentiment of gaming is negative. It's translated into stock prices, and it's consequently also translated into tokens in that area. So what will trigger sort of revival in tokens, not product, but tokens, is going to be a macro sentiment change in gaming, we think. And we think that will happen because of the launch of, Nintendo Switch 2, which is actually coming out this month. The fact that they've changed the pricing in gaming. So, the Mario Kart, the new Mario Kart is physical copy is charging $90, which is way higher than ever before. Crazy. But you know what? Yeah. It's still the cheapest form of entertainment. And when you think relative to inflation, it's actually very reasonable, which will create a bump in gaming revenues. And of course, next year we have Grand Theft Auto, which is going to be sort of the biggest thing ever. And the other thing about tokenization, and you saw this with MapleStory as well, is that more large game companies are all now going to be looking at launching tokens, whether it's to build networks or maybe to create financial effects from them. And again, the largest gaming companies in the US, which is like, many of them, whether it's an EA or whether this is Microsoft Activision or whether this is like a Take-Two, Rockstar with GTA, they may not issue a token very quickly, but they will no longer block the activity if people are building stuff on it, because you don't have an SEC that says you're launching a security, right? And so I expect a lot more of that to happen, and as a result, much more adoption from those areas. So I do think gaming will continue to drive user adoption, but I think the token values will come from the industry sort of having a broad resurgence, which we think will happen closer towards the end of the year, and of course next year with Grand Theft Auto.
Bitcoin might sound complicated, but the Gemini credit card makes it simple. Use it like any credit card. Buy lunch, gas, or your weekly groceries, and you'll earn up to 4% back instantly in Bitcoin or one of over 50 other cryptos straight to your account. No annual fee, and right now you can grab a $200 Bitcoin intro bonus. It's the easiest way to start building your Bitcoin stash. Go to gemini.com/CIA to learn more. Terms apply.
You beat my question. Yeah, I was going to ask you what was your sentiment on gaming if you felt that it was declining over the years, but you already got to it. You also brought up earlier stablecoins, and that is definitely a massive product market fit. We're seeing it as a huge narrative right now inside the industry and outside of it. I wanted to ask you about networks effects of stablecoins. I think value is looked at very differently for Tether's USDT stateside versus USDC, Circle's USDC. And I'm curious, given your perspective, you have a global presence, but you probably weigh heavily more in the Asia markets. How do you see USDT's prominence there compared to USDC? And then how do you think that's going to shift over time in America as well?
Yeah. So there's an interesting thing around, and I haven't really studied this in depth, but the fact that the dollar has been, and just then we'll get into stablecoins as well related to that, the fact that the dollar has been inflated the way that it has with QE has inadvertently, funnily enough, expanded its power because its circulation is wider than ever before, right? So it's no longer, it hasn't been a store of value for a long time now, but as a means of exchange, and therefore as a network, it's probably the most powerful it's ever been, right? And so there's an interesting tension when you think about tokenomics and tokens as well, around circulation and distribution versus value accrual, right? And so I think this is also interesting about some of the struggles that Ethereum has in terms of what am I? Am I a store of value or a medium of exchange?
They're going through an identity crisis,
exactly.
Yeah.
versus something like a Bitcoin, which at the end of the day, it is the ultimate store of value. And I'm somewhat sort of less optimistic on utility on Bitcoin because that's not the point. Nobody wants to spend their Bitcoin, right? Versus Ethereum really depends on utility and usage. And when NFTs were at their peak, so this is the other thing. NFTs are very much, I think, at the core of what helped Ethereum grow at the time. Now, NFT sales volume is still $500 million a month. So it's good. The thing is, it's fragmented through many L2s as well as different L1s. So while Ethereum is dominant, it's around $150 million a month, right? Versus if Ethereum had, back to $500 million, right, relative to when the market was bigger, they actually would have much more utility use case. And the utility isn't that people are holding Ethereum because they think it's a store of value. It's the opportunity of buying that next NFT or investing in something in that ecosystem. So I'm holding it. It becomes my reserve asset for that ecosystem, right? And you see the cycle where, okay, I make money on Solana and now I'm going to take a portion into Bitcoin as my sort of digital gold, right? And with Ethereum, you see the same thing. But why should I hold more Ethereum? Because of the opportunity of doing something, right? And I think that's sort of that challenge that they have. Precisely what we see with the dollar, the devaluation of the dollar actually expanded its utility in a way, right? And its network. Now come to the question on stablecoins about things like Tether. So Tether versus Circle. So if you are an institution historically, although that's changing, you would trust Circle more, at least in Asia, because it appeared to be more legitimate. Versus, the Tether thing was like, oh, it's not like we don't know about the reserves, and there was some scandals before. I think everyone in our industry is very, very comfortable with Tether and knows that they're solid. But if you're outside, you're sort of a little worried about that and you don't quite understand it. So I do think that Tether has very much solidified themselves as the crypto natives stablecoin. Right? It's like if I'm going to have a stablecoin, I'll keep it in Tether because I seem to trust that more natively. I think that it'll always have that sort of position, but it will get challenged by other stablecoins, and I think it will be because of the user growth will come from people who are not Web3 natives, right? We're getting to this point where we're moving into sort of an early majority stage of crypto, and they're not necessarily all going to be using Tether. They're going to come in with this new wave of stablecoins. So, for instance, in Asia, the Hong Kong Monetary Authority basically has now a license framework for stablecoins. That in many ways actually being ahead of the US with the Genius Act. And we with Standard Chartered are one of the sort of participants in this. And just picture this, right? You've got a central bank that has now a license framework for a stablecoin, and we, as a crypto digital digital assets business, have entered in a joint venture with Standard Chartered, which is a note issuing bank, in Hong Kong, to basically partner on a stablecoin. I mean, this sounds like, oh yeah, of course, but actually, it's kind of it's remarkable because it's not just a license from the your central bank. It's working with one of the biggest banks to do so, right? So it hasn't happened in America yet, for instance, where a crypto native firm is joint venturing with Bank of America to issue a stablecoin. But this will happen, right? This will form in America as well. So this is kind of sort of an example of what's happening. And so there's going to have a lot of these stablecoins coming out, and they're going to onboard their users into the space. And so there's going to be competition. But what's the market they're trying to address, right? So there's the dollar side, and that's sort of happening there. And I think Tether and Circle are going to have somewhat of a different fight. And I think yield-bearing stablecoins are going to be an interesting conversation. Whereas what's happening in Hong Kong is really, even though the Hong Kong dollar is pegged to the US dollar, it's really the first step of a broader experiment, which is around things like, renminbi flows, right? I mean, at the end of the day, Hong Kong is the largest clearinghouse for basically Chinese bonds, as in dim sum bonds, right? And of course, renminbi broadly. I think Hong Kong clears something like $2+ trillion of renminbi a day, right? So that's, small compared to the dollar, but massive, generally speaking, and it's probably the second largest other currency from a clearing standpoint, which is also the reason why the US has also targeted Hong Kong the way that it has, because, it is the international financial clearinghouse for China, right? And so we see, as the world sort of divides itself between sort of these two narratives, there's going to be stablecoins coming from this part and stablecoins come from there. And the permissionless nature means that they will flow freely. I mean, this whole sort of business around tariffs and sort of protectionism and so on, how do you freely sort of, trade between them? Frankly, crypto is a very natural solution to this. And then, of course, agents as well, right? What is the currency of agents? If you want to do it in the sense where it's not based on tokens issued by the agents, which is another topic, but actually it's based on currency we all use, stablecoins is the natural currency for that, right? So we see some fragmentation. I think it'll eventually come down to the point where most users might not even know what stablecoin they're using. Stablecoins on the back are going to be clearing automatically, right, based on the enterprises that use them in some form or fashion, but they just know it's a US dollar, or they just know it's a Hong Kong dollar, or they just know it's a currency. They don't really have to care which bank clears it for them, because on the back, it's just one currency for, let's call it 90% of the world. And for the 10% of us or the 5% of us who care, we might sort of create our identity around a Tether or a Circle or whatever, but that will remain sort of, I think, more of a niche going forward. Although it will be a meaningful niche, but it won't be anything that will be sort of dominant, we think.
The Tether CEO has floated the idea of potentially launching a US dollar-backed, stable coin to compete with Circle. Do you see them doing that? Do they need to do that? Are they already the winner in the market?
So I think that they're definitely the largest one when it comes to the native space, and there's clearly, and I think as long as they keep paying T-bills, they'll maintain good favor. Right, that's part of the strategy there, I would imagine. But do they really need to compete with Circle? I mean, I think the challenging thing with regimes that have regulations around the world, let's say like Hong Kong now has a stablecoin license. Europe with MiCA obviously has a format as well. As elsewhere around the world, they're going to do that. What's not clear to us, and we should expect, is that can stablecoins that are not licensed in certain territories operate on those markets going forward? That's not clear at this moment in time, right? And so I do see challenges that might emerge from that. Right? And I think what happened in Europe with Tether is an early example of that. And so if you are a Tether, I think that the strategy of saying we're going to do a dollar-backed version of that might be compliant to maybe the future sort of Genius Act, like whatever that may look like, is really a way to make sure that they have an operator in the specific countries that they're in, right? And so I expect that to happen in most countries around the world, right? So that means if you're Tether, or if you're Circle, or if you whatever stablecoin, if you want to operate in a place, you probably need to work with the license frameworks as they get established. And it's because those places don't have a license framework that they don't have to do anything yet. But this will happen very quickly, I think, right? And so I think there's going to be a little bit of a race around that.
Mm-hmm. You've recently said that Hong Kong has leapfrogged quite a few other jurisdictions, including the US, with its new stablecoin ordinance. What other regions and or countries do you think are getting it right when it comes to thoughtful policy regulation that's kind of propelling Web3 technology forward opposed to stifling it? Obviously, we've heard your take on Hong Kong so far, so feel free to tie that in as well. But I'm curious what other areas you think are doing well.
So I think obviously, UAE is definitely sort of doing really well in that area. I mean, between what's happening in Dubai and Abu Dhabi, they're sort of leading the way. It's quite unique there because, everyone at the government levels as well seems to be sort of, big holders of crypto of some sort, right? So there's a very sort of the aligned culture there, broadly speaking. Right? And so I think they've got some of the first and most advanced sort of, regulatory policies around that. Interesting enough, on stablecoins, I would say they're a little bit behind a place like Hong Kong. But I think Hong Kong really tried to fast forward on this one very, very sort of, aggressively. I think the other thing, again, why policies work faster in places like Hong Kong or UAE is because they're both, particularly Dubai, they're both financial centers. So there's a natural willingness to collaborate between business and sort of the financial sector together to do something and find a solution around that. And it's also a really powerful way for small business, sort of small nations or small areas and locales to have global influence. Right? I mean, that's the thing, right? It's like, Dubai isn't, UAE isn't a very big place, but it's become a very important place, for crypto. And Hong Kong, in order to maintain its status as a financial center, needs to essentially embrace that in order to stay relevant in this sort of new world of finance. Now, other territories, I think Southeast Asia is very much trying to be progressive there. Philippines, interestingly enough, is actually fairly progressive because so many Filipinos rely on crypto. So it's almost like they got to do something around that. But then you have other examples where regulation is fraught, but it's sort of inevitable. So like South Korea is an interesting example. I mean, South Korea is actually going through elections right this moment in time. And what's interesting is that the reason why South Korea has this crazy amount of trading, I think as a market, it's the highest trading volume as a single market for crypto. And I think the stat is I think 60% of people under the age of 30 almost exclusively or primarily sort of trade in crypto. And that's because
I think the volume passed TradFi for a day or two, right?
Yeah, I mean, it's wild.
Crypto,
it's absolutely wild.
Actually passed. Yeah, it was crazy.
But the reason is because there's no taxes for crypto trading, and this was let's call it a moratorium that they did, and now because of elections, right? It's so unpopular if you tax crypto that it's very unlikely that any new sort of elected governing official is going to say, well, it's time to start taxing crypto. And as a result, it's kept extending. And so in those markets, you have a situation where the population is quite crypto savvy and crypto aware, but the policies around it are struggling with it a little bit because they're trying to do something that they can't pull back and figure out as a revenue source, all that kind of stuff, right? So in some ways, it's actually holding back some of those developments, even though you've got a very ready population, but you don't have all the policies there. Japan was very, very forward, actually. When a lot of people didn't realize that before the whole SEC, America opening up to crypto, Japan already had a framework for legalized, essentially ICOs, right, with the GFSA. And they had a policy framework around crypto that was actually, because of the Mt. Gox scandals and all that stuff before, they were actually ahead. But because they had very heavy taxing, particularly on unrealized gains in crypto, which just changed, right, and will probably go into effect next year, but just changed, it actually dampened the effect of people trading in crypto relative to Korea, even though broad markets and the capital in Japan is larger, right? So it's to say that you could have very progressive policies on one hand, but if you have other policies that aren't conducive, like tax policies, for instance, right, then it can negate all the efforts, because Japan could have become the real leader in Asia if it had more progressive tax policies around treatment of crypto assets at their time. And now they're playing catch up. They realize that, which is why, they changed it. But of course, it takes time, as things do sometimes in politics, unless you're in America, I guess.
Yeah, I want to ask you a follow-up about that sort of jurisdictional, I guess you could call it arbitrage, or the sort of follow the leader, specifically as it relates to fundraising. So in the US back in 17, 18, right, we had the ICO kind of bubble and burst, on the Clayton memo. We shifted to this sort of like, maybe we'll do SAFs for a little while, right? And we've been trying to sort of thread the needle on some of these compliant fundraising structures. Now we're in kind of this like safe and warrant territory in the US, but we have a lot of launch pads, a lot of reclassifications from the SEC. And it seemed like for a while, if you were investing in Asia, the goal was to largely be kind of compliant with what we're talking about, sort of the deepest, most liquid market in the world, right? So it was our docs, if we're an Asian company or an Asian investor, should work in the US. And then I think under the last administration, we actually saw that kind of deviate. It seemed like maybe Asia was less concerned with complying with US laws because it was such a mess. And things, the SAFT continued. We have, direct sort of token purchase agreements, and there's a lot of tax considerations there, as you mentioned. Do you think with the new administration, or with this more global approach, we're going to get back to kind of I don't want to call it a unified fundraising mechanism, because every situation is different, right? But how do you see us sort of coalescing, around kind of regulatory clarity?
So first, I would say the reason why people, including ourselves for a while, avoided the US market is because it was more like, what laws? We don't understand them, right? It was
Right.
just like, so it was no point, because you knew that it was just going to end badly. So why even bother? So the emphasis was around other markets that had more regulatory clarity, or it was clear that they weren't going to sort of intervene in those areas. Like, for instance, Hong Kong was very clear, and frankly, so was Japan and other territories in Asia, that, their treatment on NFTs was very, very clear. It's like, we don't want to regulate that. That's not something that we as a securities, whichever sort of, nation that was, were going to deal with, which was very different from how the SEC used to look at it. It was like everything that's a token is a potential security, and they would go after things like stoner cats and stuff like that, right? Which is like really more like it was sort of almost ridiculous, right? Actually, it was ridiculous, right? And so that just scared people away, right? And so now there is this sort of wave of, oh, look, if Trump can launch his own meme coin, then everything's okay, sort of thing, right? But one has to remind people that you're not the president. So there are certain things that maybe he can do that you can't, just to be clear. But I think when you look at things like, the proposal around the Markets Act that's looking to come out, and other things in the US, that's the clarity that I think will help America get in front of it. Because other territories in the world are not creating clear rules around what is a utility token, right? So Hong Kong, for instance, doesn't have a framework specifically around what's utility, what's security. As in, if it's a security, you follow these rules, and generally speaking, you should be okay. And frankly, it's the lawyers who make the big money here, because this sort of regulatory unknown is where a lawyer comes, well, I can give you clarity. Really? I mean, the number of US lawyers that said, oh, we can figure it out. Let's like, whether it's this 12-month rule.
A lot of very expensive pieces of paper
yes,
out there.
Exactly. I think, and so I think that's part of it. When you actually create regulatory clarity, you also do away with the semi-extortionism that happens, and an inability for regular players to enter the field, because they're like, wait, hold on. To launch a token in America, I need to spend $1 million because I need this. That immediately stops any kind of innovation in that area, right? Whereas here are the rules how to do it, right? So I think having clarity as to what is a utility token will then help others enter the field more specifically. The position that most countries take is, well, we have rules around securities. So if you fractionalize NFT, that's a security. It doesn't matter that it's, called an NFT, right? But there's some things that you can clarify, like, I think when the SEC sort of clarified that NFTs that you can earn royalties on are not considered securities. Okay, that's clear. So now we can start thinking around sort of, earning royalties on NFT sales and trades. That makes it much easier to understand that because there's a statement around that. So there needs to be some certainty around it. Now, where I think it will converge, and I think that's what we're encouraging policymakers around as we advise them to think about it, is that much like in the utility framework, we still need consumer protection. It's just a different kind of consumer protection. So if it's a financial product, sure, that's maybe where the securities comes in because it's a security. And whether this is tokenizing real estate or fractionalizing art or whatever, that could be one category. But I think that the majority of them will ultimately go into what we think is the form of consumer protection, right? So if you make a promise, it doesn't matter if it's an NFT for a game or for something or a token for some kind of utility, and the utility doesn't happen, it's kind of the same as selling a car that doesn't drive, right? So what happens when it doesn't work? You get a refund, okay? And so
Not in crypto though.
well, that's because it's new,
Not yet.
because people don't understand it, but I think that's kind of where I think it goes. As in, I think consumer protection laws are the appropriate laws for 99% of the tokens that are out there, right? If they make a promise, and if they don't make a promise, like a meme coin, fine, right? Then it is what it is. But if you're out there saying, I'm making a game and the token is used in this way, and you might be fundraising like a Kickstarter and you make specific promises that you can't fulfill, then I think it's entitled to a form of consumer protection, as we do in real life, right? In the physical world, because otherwise, we'd be buying all sorts of products that don't work, right? With buyer beware on every warranty, like let's buy from toiletries to cleaning to like food, whatever, right?
Right.
Like, so you do need consumer protection, and I think that's the lens that we take, and we think organizations need to take, and that's the maturation, and I think we're going to get there pretty fast. So it's a different framework. It's not going to be the and again, as I said earlier, because blockchain financifies everything and it becomes fintech, automatically it was like, oh, well, it's financified. So, it's financial in nature. So the SEC needs to take a look, right? But actually, if it's already in the realm of everyone, then it no longer is one category, right? And I think the US is having this conflict as well now between, well, is it the CFTC or is it the SEC, as an example, right? Like who looks at that? Because they're still trying to figure out sort of what that future looks like.
What's your take on that? CFTC versus SEC? I'm curious.
Well, I'm not in the inside chambers of this, so I can't really comment per se. But I would say that there's certainly a role between determining what is, like, when you think about the commodity side, I think most of the tokens function more like commodities versus securities if you look at it broadly. However, I think, again, none of them are viewing the utility token in the framework as a consumer product yet, right? Maybe NFTs, right? Because it's visually more addressable in that way, but they haven't yet thought of a token to follow the same frameworks, right? And so in the US, certainly there's not a conversation that I know of yet where consumer protection laws apply for tokens yet, but I think it will happen. And I would say, other than ourselves, there's not a lot of proponents out there arguing for it, because of course, why would you, right? So there's a little bit of the maturation as well. Like you don't necessarily want more regulation. I get it, but I do think it's important in this case. Just consumer protection, broadly speaking, is important, right?
Yeah, that's a big one for you guys. All right, so to wrap things up, aside from what we discussed today, what's one other thing that you're watching in DC that you think others should be paying attention to right now?
Well, so, I touched on that a little bit, but I think the big one to watch on in DC is the sort of being able to sort of categorize what is a utility token and what isn't.
The taxonomy.
Yeah, exactly.
Right.
Because once you have that, I think it opens the floodgates, not just for US companies, but for everyone out there saying, oh, now I can launch a token in this way, and it's outside of this realm. And I think it's going to really sort of create this very groundbreaking innovation around sort of really developing tokens that people feel restricted. Now, if you're in the crypto industry, you are used to living on the edge because you've been living on the edge all your life. So you're looking at what's happening with the Trump administration. And you're like, yeah, let's go. It's great, right? But if you're a large corporation or if you're a medium-sized business that's got something going, why would you take that chance? Like, like it's like, and while I don't agree with the mindset, there's a lot of people saying, oh, you know what, it's Trump. So, but what happens when Trump is no longer president? Is the whole crypto policy framework going to change? And while we could say it's become much more bipartisan, there is that narrative. But if it becomes something that's legally very clear, and it's passed by both the House and the Senate, for instance, as an act of law, then you can do it, and there won't be any prosecution around that, and there's absolute clarity. People want that clarity, right? So I think that's going to be very important, and I think it will be the model that the rest of the world that isn't in crypto will emulate, right? Because the U.S. has been always that model. It's like, okay, U.S. is coming out with a stablecoin bill, with the Genius Act. Once that passes, I imagine many other countries that do not have a stablecoin bill are just simply going to say, we're going to do that, right? And that's how we're going to be compatible with the US, because it's about their relationships with the US, of which the US is generally mostly the largest trading partner of, most parts of the world. So that kind of framework will happen, and the US leads. I think the fact that crypto has been so negative in many parts of the world was very much US led as well, right? And it wasn't because, it wasn't only because they were negative and they were like, oh, we're not sure. It was also sort of, we don't want to be in disfavor with America, right? And now it's the opposite. Well, we want to make sure we are in favor, and therefore we need to embrace crypto. It's just a more open form of financial diplomacy, if you want to call it a bit more diplomatically. But it's something that I would say also in DC. The other thing to look at is this dynamic around sort of the Trump family in terms of their activities in the space. It's probably the most openly active in the space of an industry that is affected by the president. And while we could clearly one could say that there's separation, and I don't know the inner workings, it has never been so overt, right? That's the other thing. And I think the rest of the world is also looking at that both with amazement but also trying to figure out how to deal with that. I mean, when you have group of I think there's a story around sort of large sort of the whole sort of I think it was shareholders of or owners of like TikTok buying sort of World Liberty finance tokens, right? I mean, this was sending a signal, right? And that signal used to be, I'm buying lots of T-bills, or I'm doing a trade deal with America, or I'm opening up a factory in America, right? That was that kind of message, right? And now it's I'm buying your token, which is a different kind of message, but still the kind of message. Like, what does that
Very
mean,
different.
right? Yeah, exactly. Yeah.
Well, yeah, thank you so much for coming on. We appreciate it. We'd love to have you back.
Yes, thank you.
Thank you for having me.
Thank you.